Welcome back to the deep dive. Today, we're jumping into something pretty interesting. The Q2 2025 update from a company, well, you definitely know it, but maybe not as they're describing themselves now. They're talking about being at a seminal point.
Yeah, it's a big statement, and it signals, more than just the usual quarterly check-in. This is about a fundamental shift.
Exactly. So, our mission for you in this deep dive is to really unpack what's in this report. We've got the financials, the operational stuff, but also this big strategic pivot they're announcing.
We're going to look beyond just the numbers, right?
Yeah.
Highlighting the strategic moves, some honestly surprising tech advancements. It's fascinating to see this move from, the EV and energy leader we know.
To potentially a leader in AI and robotics.
Precisely. That seems to be the core message.
Okay, so just to give everyone a quick baseline for Q2 2025, we're looking at $0.9 billion in GAAP operating income, $1.2 billion GAAP net income, and $1.4 billion non-GAAP net income.
Right, and just a quick reminder, GAAP is the standard accounting. Non-GAAP often tweaks things to show maybe a clearer operational picture, sometimes adjusting for one-offs.
And the key takeaway here isn't just the dollar amounts, it's that these numbers seem to reflect a deliberate choice, right? They're spending heavily on this AI and robotics future, even if it means profits look a bit, well, lower in the short term.
It's that classic investment phase dynamic. You spend now for potentially much bigger gains later. So yeah, let's dig into the automotive side first, because that's still the bedrock, but things are definitely changing there too.
Okay, so financially, what did the automotive business look like this quarter?
Well, overall revenue was down 12% compared to last year, landing at $22.5 billion. And operating income, that took a bigger hit, down 42% year over year to $0.9 billion.
Oof, 42%. That translates to a 4.1% operating margin, which feels lower than usual for them.
It is lower. And the why behind it is, well, it's layered. Part of it was lower vehicle deliveries, sure, but also less revenue from those regulatory credits.
Ah, yes, the credits they sell to other automakers.
Exactly. And also, the average selling price per car was a bit lower, mostly because of the mix of models they sold.
Okay, so multiple factors hitting revenue. What about the operating income drop specifically? Was that just the lower revenue flowing through?
That was part of it, especially the lower regulatory credit money.
Right.
But a big piece was a significant jump in operating expenses. And that increase was, primarily driven by huge investments in AI and other R&D projects.
So there it is, the R&D spend directly impacting the bottom line. A conscious trade-off, it sounds like.
Yeah.
Were there any counterweights, anything positive financially on the car side?
There were a few things. They had lower restructuring charges, which helped. And the cost per vehicle actually went down a bit, mainly due to that change in product mix and lower raw material costs. But those positives were kind of offset by things like lower fixed cost absorption, basically, factories not running at full tilt, and some increased tariffs. However, a real bright spot was the energy business. Its gross profit grew quite a bit. We'll definitely get to that later.
Good, yeah, let's circle back to energy. But sticking with cars for a minute, production and deliveries, how did those numbers look?
So total production was actually flat compared to last year, around 410,000 vehicles. But deliveries, the cars actually reaching customers, were down 13% year over year, to about 384,000.
Flat production but lower deliveries. That points towards inventory building up.
Exactly. If you drill down, Model 3 and Y production, their core volume cars, was actually up slightly, about 3%. But the other models, think S and X, saw a pretty sharp production drop, down 45%, and deliveries for those were down even more, 52%.
Okay, so the main models are holding steady on production, but the higher-end ones are down, and overall deliveries lagged production.
Right. And that translates directly to inventory. Global vehicle inventory, measured in days of supply, went up from 18 days to 24 days. So cars are sitting a little bit longer before being sold.
That makes sense, something to keep an eye on. But even with those shifts, they had a massive milestone, didn't they?
They did. Their 8 millionth vehicle rolled off the line in June. That's just incredible scale achieved relatively quickly.
Absolutely staggering. It puts the quarter-to-quarter fluctuations in perspective. So how are they managing expansion in products right now? What's happening globally?
Well, in North America, they actually saw record test drives, up 20% from the previous quarter. Seems getting people to try the cars, maybe especially FSD supervised, is key.
Makes sense. Any new offerings there?
Yep, they launched the long-range rear-wheel drive Model Y back in May. Hits a sweet spot, 357 miles of range, starts under $45K before you factor in incentives, makes the Model Y accessible to more people.
Good strategic move. What about APAC? Asia Pacific is huge for EVs.
Definitely. Gigafactory Shanghai is still the main export engine there, and they saw record delivery numbers in several markets: South Korea, Malaysia, the Philippines, Singapore. Big news was also properly entering India, launching the Model Y there in July. That's the world's third largest car market, so a major step.
Is huge, yeah. And safety, always a big talking point.
Always. The refreshed Model 3 did really well. Got a 5-star overall rating from ANCCAP, the Australasian safety body, and get this 95% for child occupant protection, which they said is the highest score ever against their latest, tougher criteria from 2023-2025.
Wow, 95%. That's impressive. Europe, too.
Yep, similar story. Model Y was the bestseller year-to-date in Norway and topped the charts in June in places like Turkey, Netherlands, Switzerland, Austria. And the refreshed Model 3 also snagged a 5-star Euro NCAP rating, becoming, by their latest scores, the safest car tested.
So strong safety credentials across the board and FSD. What's the plan for rollout, especially internationally?
They're gearing up for a broader release of FSD, the supervised version, in both China and Europe later this year. But crucially, it's all pending regulatory approvals in those regions.
Right, regulation is always a big hurdle there. Okay, so that's a good picture of the automotive side, still strong, hitting milestones, expanding, but definitely feeling the effects of this strategic investment and market shifts.
Exactly. Which brings us back to that seminal point. This Q2 update feels like it's less about the cars themselves and more about what's next, this pivot to AI and robotics.
Yeah, it feels like the real headline. They're explicitly saying we're becoming an AI and robotics company, too.
It's not subtle. They're framing Q2 2025 as the start of that major transition. It seems foundational to everything they're planning.
So the poster child for this is Robotaxi, been talked about for ages. What's the actual status now?
Well, they officially launched the service in Austin back in June. It started with a safety rider on board, which is pretty standard for initial rollouts.
And the tech approach? Still the camera-only vision system.
Yep, stick to their guns on that. Camera-only architecture, using neural networks trained on, the massive amounts of data flowing in from their millions of cars already on the road globally.
That data flywheel is key for them.
Absolutely. It allows for continuous safety improvements, they argue, faster scaling of the network, and ultimately, they believe, profitability.
And then there was that aha moment, as the report called it, the autonomous delivery.
Right. This was pretty wild. They apparently had a brand new production Model Y drive itself from the factory in Austin, across town, including highways, about a 30-minute drive right to the customer's home. First time that's happened autonomously, they claim.
Wow. Okay, that's more than just a demo. That's a real-world point A to point B task completed.
Exactly.
Yeah.
It really underscores the potential application beyond just hailing a ride.
Yeah.
What are the plans for scaling this up, though? Austin first, then elsewhere.
They're planning to keep improving it and expanding in Austin naturally and start testing in other U.S. cities. But they made a point of saying their efforts aren't really location-specific.
Meaning the core AI learning isn't tied to detailed maps of one city.
That seems to be the implication. The idea is that the system learns general driving skills, which should allow for quicker scaling once they sort out local regulations and logistics. It's not like they have to remap every single street corner from scratch everywhere they go.
That's a big advantage if it works out. And they launched an app, too.
Yeah, a Robotaxi mobile app. Apparently, it builds on the existing Tesla app, so it should feel familiar to owners. Does all the usual stuff, request rides, track the car, set the cabin temp, unlock with your phone, handle payment securely, trying to make it seamless.
Makes sense. You need the whole ecosystem. Now, underpinning all this AI ambition is the compute power, right? The actual hardware doing the training. Any updates there?
Big updates. They significantly expanded their AI training compute, added another 16,000 NVIDIA H200 GPUs at Gigafactory, Texas.
16,000. That's a lot of horsepower.
It is. It brings their total compute power up to the equivalent of around 67,000 H100 GPUs, which are sort of the gold standard right now. They're basically building this massive AI brain.
And that investment pays off not just for Robotaxi, but for improving the cars people already own.
That's the unique angle, isn't it? Existing cars get better over time with free software updates. They gave this great example, someone who bought a Model 3 back in 2017.
Right.
That car now has features like Sentry Mode, Dashcam Viewer, the automatic blind spot camera, dog mode, Tesla profiles, the trip planner in the app, battery preconditioning for faster charging, even Netflix and YouTube. None of that existed when the car was built.
It's a fundamentally different value proposition than traditional cars, where it's usually static once you buy it.
No.
Okay, so looking forward, what new products fit into this AI and robotics future?
Well, first, there's still that focus on the more affordable model. They said the first builds happened in June, and they're aiming for volume production in the second half of 2025. That's key for getting more EVs and potentially more data sources out there.
Crucial for scale and beyond that.
Then there's the Cybercab. This is the purpose-built robotaxi, not just a modified Model 3 or Y. That's planned for volume production in 2026.
And that's the one using the new manufacturing process.
Yeah, the revolutionary unboxed manufacturing strategy. Building big chunks of the car in parallel and then assembling them, aiming for way faster and cheaper production.
That sounds potentially game-changing if they pull it off. Anything else on the product roadmap?
The semi-truck is also slated for volume production in 2026, so affordable car, purpose-built robotaxi, and commercial truck all coming relatively soon.
Big couple of years ahead for them on the product front. Now, you mentioned the energy business earlier as a bright spot financially.
Yeah.
Why is that part considered more critical than ever in this new AI context?
Well, the thinking is pretty straightforward. All this AI, all these EVs, all these potential robotaxis, they need vast amounts of clean, reliable electricity. So the energy generation and storage side of the business becomes absolutely essential to support that growth.
It's the enabler.
Exactly. And their Megapack product, the utility-scale battery, is positioned as key here. It helps make the existing grid more efficient by storing energy when it's abundant and releasing it when needed. Basically lets utilities get more out of the power plants and transmission lines they already have.
And how does it stack up economically and in terms of deployment speed?
Pretty impressively, according to the report. They say when you pair Megapack with solar power, it's already cost competitive with traditional fossil fuel power plants. And importantly, it can be deployed about 4 times faster. 4 times faster. That's significant.
Huge difference in getting capacity online quickly. And the momentum seems real. Their energy storage deployments, Megapack and Powerwall combined, basically hit their 12th consecutive quarterly record in terms of trailing 12-month figures. And Powerwall, the home battery, had its 5th consecutive record quarter.
So consistent, record-breaking growth there. Are they making these everywhere?
They've started deploying Megapacks made at the Gigafactory in Shanghai, which is important. They noted that regionalizing manufacturing for energy storage is becoming critical because of global trade policies and logistics. Can't rely on just one factory for the whole world.
Makes sense. And all this growth led to...
But record gross profit for the energy generation and storage division, $846 million. Clearly a very healthy and growing part of the company.
Definitely a strong pillar. Okay, what about the services and other bucket? That includes supercharging, right?
It does.
But
And that segment saw impressive growth too, gross profit, up 64% just from the previous quarter. A big chunk of that improvement came from better gross profit on supercharging, simply due to more people using the network.
And are they still expanding the network itself?
Oh, yeah. Added over 2,900 net new stalls globally. That's an 18% increase year over year. Brings the total number of connectors to over 70,000 worldwide. It's a massive infrastructure build-out.
70,000 connectors. Wow. Is AI playing a role on the service side too, beyond just the cars?
Yes, they're integrating AI agents now to help customers. The idea is these AI agents can resolve queries faster, cut down wait times, and even help people order accessories or parts without needing to talk to a human.
AI for customer service.
And they mentioned they're using the same kind of AI tech internally to help their service technicians diagnose problems and speed up repair turnaround times. So AI is permeating operations, not just the end product.
Interesting. Okay, one last piece on the operational side. Batteries and manufacturing. Any updates on their efforts to bring more of that in-house and onshore?
Yeah, progress there too. Their lithium refining plant and their cathode production facility, key steps in making battery materials, are apparently on track to start production sometime in 2025. That's a big move towards bringing that critical supply chain to the U.S.
Reduces reliance on overseas suppliers.
Exactly. And related to that, they're also on track to start domestic production of their first LFP battery cells later this year. LFP, lithium iron phosphate, is often used in energy storage products and some vehicle models. So producing those cells themselves in the U.S. is another key step.
Okay, so lots of moving parts, automotive shifts, huge aerobotics push, strong energy growth, and progress on vertical integration. Bringing it all together, how does this leave them financially? Are they stable enough to fund all this ambition?
Well, at the end of the quarter, they had $36.8 billion in cash, cash equivalents, and investments. That's a very solid buffer. They did generate $0.1 billion in free cash flow. though the total cash pile decreased slightly by $0.2 billion, dollars, mainly due to some restricted cash changes in financing activities.
So still a huge war chest, basically.
Absolutely. They explicitly stated they have enough liquidity to fund their product roadmap, the factory expansions, everything. That's the key message they wanted to convey.
And this is all happening even with, the broader economy being a bit uncertain.
Right. They acknowledged the uncertain macro environment, but said they're continuing to make these big, what they call high-value investments in CapEx and R&D anyway, while still keeping that balance sheet strong.
So the strategy is full speed ahead on the investment front. How do they see profits evolving with this shift?
They expect the traditional hardware profits from selling cars and energy products to be increasingly joined, and eventually maybe even overshadowed, by profits from AI, software, and fleet-based services, like Robotaxi.
A shift from hardware margin to software and service margin over time.
That seems to be the long-term vision. In the meantime, the focus for vehicles is still on growing volume, but doing it in a capital-efficient way. That means really maximizing the output of their existing factories before building brand new production lines.
Makes sense. Squeeze more out of what you've got. And that future vision still firmly includes the cybercab.
Yep, still targeting volume production starting in 2026, using that unboxed manufacturing process they think will be revolutionary for speed and cost.
Okay, so when you step back from all the details, this deep dive really paints a picture of a company undergoing a pretty profound transformation, doesn't it? It's not just about making better electric cars anymore.
Not at all. It's about fundamentally changing what the company is, building this AI and robotics layer on top of the automotive and energy foundation. It's incredibly ambitious.
It really is. Okay, as we wrap up, here's something to chew on. Think about this strategy using millions of customer cars out driving around every day as data collectors to train these incredibly complex neural networks for autonomy. We saw the Robotaxi launch, that autonomous delivery.
Yeah, leveraging the fleet is central.
So how could that actually redefine things? Not just transportation, but maybe even the idea of owning a car or the whole business model of a car company. What happens when your car keeps getting smarter, genuinely more capable, for free, long after you bought it?
And the company starts seeing its future profits coming more from software subscriptions or ride-sharing services linked to that car, rather than just the initial sale.
Exactly. What kind of ripple effects could that have? Not just for other car companies, but maybe for insurance, urban planning,
Yeah.
logistics, even beyond. It's a fascinating future they're trying to build.